This podcast is brought to you by Knowledge at Wharton. Please visit knowledge.wharton.upenn.edu for more information.
I'd like to add my welcome to the fourth teach-in on the global economic crisis. Thanks to Tom Robertson and Vice Dean Anjani Jain for sponsoring the event, and also to the panel members who were just introduced. It's not hyperbole to say that the world is a different place today than when we started the semester only about 7 weeks ago. The U.S. Treasury and the Federal Reserve have bailed out and in some instances taken ownership positions in the largest mortgage, insurance, and banking institutions in the country. There are large investment banks that either cease to exist or no longer exist in the same form. They've become bank holding companies with substantially different leverage limitations. Asset market volatility has led us to be relieved on days when movement is only about 3 or 4% rather than 8 or 11. Even those not actively involved in financial markets are horrified when they open their 401k envelopes or they choose not to open them, hoping that stocks, in fact, really will be right for the long run. We face the specter of a serious economic downturn. With a policy arsenal that's already challenged, the federal funds target rate for the Fed is already near a historic low. It's at 1.5%. It's only gotten down to 1% before. And we're at record budget deficits even before we factor in the bailout package, which is yet to be implemented. So fiscal policy and monetary policy are already strained, and we're facing a specter of a fairly significant downturn. There have been unprecedented coordinated global responses to the credit market issues. Central banks have taken efforts to increase liquidity and lower interest rates. Of course, we're in the midst of a presidential election, and though we do not intend to make any partisan statements, there certainly are challenges for whoever should prevail in 2 weeks from now. So this afternoon, the four panel members will provide some insights on a number of things, including the causes of the current crisis, measures that are presently being taken to alleviate the crisis, remaining challenges to both financial markets and the real economy and their effects on us, and then implications for further policy measures, including the possibility of regulatory issues to prevent recurrences. Each panelist will have 10 to 12 minutes to make a statement, after which they'll be able to discuss the statement just made. After the four panelists have finished with their remarks, we'll open the floor to questions, and there will be floor mics run around, and so you just raise your hand to indicate your interest in asking a question. Obviously make your questions succinct. Don't make a speech asking for saying, is that right, at the end, otherwise you'll force me to use my incredible powers as moderator. But with that, I think we will go ahead and start with Professor Richard Marston.
Well, thanks a lot, Martin. I'd like to begin by saying that Tom Robertson was wrong. It wasn't Wharton that caused the crisis, but according to the Financial Times this morning, it was Harvard Business School. It's definitive. They were having their anniversary celebration, and Drew Faust, who is the president of Harvard and used to be a professor of history here, she actually said, you know, you ought to change your model. It shouldn't be for you to do well in the world, but to do well for the world. And I think that's interesting that Tom actually talked about something similar. This financial crisis is spread everywhere. What I want to do is just begin to talk about it, and then we have three of my colleagues to talk about other aspects of it. And I thought I would begin by talking about where it all began. You know, it sort of helps to identify the beginning of the crisis. This time it was in the mortgage market. So what I want to do is I want to show you 4 charts about housing, and I think they'll be a little surprising. The first one is about when the housing crisis began. It began in November 2005. Isn't that amazing? Because that's confusing to me, because during 2006 and into 2007, Merrill Lynch and Citigroup and Bank of America, et cetera, were adding to their mortgage-backed securities. Were they unaware that housing had already peaked and it was on a downhill slide where it's now 62% below where it was before? Bit of a puzzle, you know, bit of a puzzle. Are they so insulated in New York? You know, they don't have very good communications there. There's so many towers, it's difficult to get cell phones. So possibly they didn't know about the housing crisis in America, but somehow, as a result, they took a lot of positions, even in 2006 into 2007. Second chart. What has happened to house prices since that time? Well, you can see these are wonderful indices from Case and Schiller. Bob Schiller used to be a professor here. What it does is it shows you that the pain is distributed unevenly across the country. If you're from New York, or you're from Boston, or you're from Chicago, there's been relatively little decline in prices, only 10 or 11%. But in some regions of the country, it's been awful, absolutely awful. And that's where an awful lot of the pain in the securities market is originating. California, Florida, as well as, of course, Phoenix and Las Vegas. The sad case is Detroit, because they never saw a rise in the house price to begin with, and yet they're down so far. So that's the second chart. My third and fourth chart address the issue of how soon is the housing market going to turn around? Well, actually, I'm a pessimist. But I must admit, I only have one data point. When you run regressions, you probably try to have a whole bunch of data points, but I only have one. I can only look at the last housing crisis, the last time we had a boom in housing, and ask, how soon did the housing price reach bottom? And I'm going to look at California on the one hand. We reached a peak in 1989. When did it turn around? Sometime around 95, 96, 97. All right. Now, of course, there's special things going on in California. There's always special things going on in California. So we have to say, let's move to the other side of the country with my final graph, and it shows you basically, whoops, it shows you New York. And you can see very similar story. Reached a peak in 1988, didn't reach bottom until about 6, 7 years later. There are those who say, well, housing has to turn around before the economy turns around. Let me say, I hope that's not true. I hope the economy turns around long before housing, because I think it's going to be a while before housing turns around. I told you I only had one data point, but I think it's a relevant data point. We'll wait and see whether or not housing prices will reach bottom sooner rather than later. I think it's going to be later. So then we began with a financial crisis. Because of the mortgage-backed securities originating in housing, they started to go bad, and that generated the financial crisis. I'm of the belief that financial risk spreads were down so low that we probably would have gotten a financial crisis of some sort from some other source if it had not been in housing. But it happened to be in housing. So we began the crisis, and you know the details of the crisis. What I want to focus on is just a couple of things. Number one, has the Fed done its job? Well, let's think about what is a central bank supposed to do in a financial crisis? I think there are three things they're supposed to do. Number one, they're supposed to lower interest rates. The Fed did its job. Lowered interest rates. They were 5.25% summer before last, and now they're 1.5%. In fact, if I were on the Federal Reserve Board, I would vote against any further declines. The problem in America is not the level of the Fed funds rate. It's the fact that you can't get a loan anyways. And if you do get a loan, it's going to be at a much higher interest rate than the Fed funds rate. So the Fed's done its job in terms of interest rates. Second function is to make sure that the banks have lots of liquidity. That's through the discount window. What the Fed does and every central bank does is it accepts securities in exchange for Treasury bills, and the Treasury bills are like cash. Well, let me tell you, they've had to do a lot of that. Let's begin by showing you the spread of LIBOR over Treasuries. That's the interbank offer rate in London. It's the barometer of interbank lending in the dollar market. And let me tell you, back in August a year ago, it looked pretty grim. Now, normally the spread of interbank interest rates is about 0.5% above Treasuries, 0.5%. But last August a year ago, it went way high. At that point, the European Central Bank and the U.S. Central Bank stepped in, provided a lot of liquidity. They had to do it again at the year end. They had to do it again when Bear Stearns failed in March. They had to do it again in July when Fannie Mae and Freddie Mac got into trouble. And you can see it, quite a bit of crisis. Now, at this point, you have to recognize the Fed's doing its job. In fact, it's had to be pretty innovative. What it's had to do is actually accept a lot of securities that it normally doesn't accept because they're too risky in order to provide liquidity to the banks. So it's done its job. But the third role is the most controversial. The central bank is supposed to save the largest banks, the banks that are so-called too big to fail. Back in the 1980s, that would have meant that the Fed would have saved Citibank or Chase or Chemical Bank or J.P. Morgan or Bank of America, and perhaps a few others. The Fed is never specific about how many banks it will save. But it saves the big banks because they're too big to fail. They threaten the system. It's going to do it this time. The only problem is that the world has changed. The old model was based on the idea that banks would accept deposits and make loans. So if you save the big banks, you wouldn't necessarily have to save the investment banks. You had to save the big banks. It would stabilize the system, and we'd live happily ever after. The problem is that in the meantime, securitization has occurred. And what has happened is the banks no longer hold on to their mortgages, no longer hold on to their loans to a large extent. What they do is they package them together in bonds, sell them off. You know that already. So things have changed. That means that the risk that the bank is holding is the same risk that is being held by pension plans, by insurance companies, by investment banks, and so on. So the concept of too big to fail has changed. And now we realize that the Treasury and the Fed now define AIG, an insurance company, as being too big to fail. That's what we found out 4 weeks ago. You know, by the way, the Treasury and the Fed decided that Lehman Brothers wasn't too big to fail. And I guess that's the one big mistake they've made. I must admit, at the time, I thought it was the right decision. But they should have saved Lehman Brothers, because later that week, let me say it delicately, later that week, the week of September 15th, remember that date, September 15th, the week of September 15th, all hell broke loose. This is the LIBOR rate, and what happened to the LIBOR rate that week. In fact, Wednesday afternoon, Thursday morning of that week, the 17th and 18th of September, I think were the scariest 2 days in financial markets in my career. They were absolutely scary. And then sometime in the afternoon, Thursday afternoon, word got out, was leaked out, that maybe the Treasury was going to have a bailout package. The market started to calm down, and, you know, things were looking good by the end of the week. But then, of course, over the next couple of weeks, we had to watch Congress. I mean, watching Congress is like going through a salami factory. I'm told that somebody who goes through a salami factory becomes a vegetarian for the rest of their lives. Well, let me tell you, it was ugly. And in the meantime, a lot of other things happened. Let me tell you, let's see, Washington Mutual had to be taken over. Wachovia had to be taken over. The market fell 20%. Boy, oh boy. And so the Treasury had to go, what I term, to Plan B. Plan B. When do you go to Plan B? When you realize Plan A is not going to work. And what did Plan B involve? Well, what it involved was the following problem. The banks had kept borrowing and getting one capital injection after another, and it wasn't enough. In the second column, you can see an estimate by Morgan Stanley a week ago on how much each of the banks had lost. And on the far column, you can see the capital injections. If you add up the numbers at the bottom, what you find is there's a bit of a gap. In other words, under the best of circumstances, the banks were deficient. They needed some capital injections. And so, once again, the Treasury and the Fed came to the rescue. And let me summarize what they did. What this chart does is it shows you the 9 largest banks, with Merrill Lynch still separate from Bank of America, the capital injection by the Treasury in the form of preferred shares, and we'll talk more about that later on. And then finally, in the last column, the actual equity value of that particular firm right at the time of the injection. What you can see, boy, this is a big equity injection, let me tell you. It's a big equity injection, and the natural question to ask would be, will Plan B work? That's a natural question, isn't it? Let me distinguish between meanings of the word work. Will the plan work in the sense that the banks will be sufficiently capitalized? Well, let me tell you, the Treasury is on the plan now. If they're not sufficiently capitalized, we'll come up with more money. That's clear. So in that sense, the plan will work. These banks will not go under. There will be other banks that the Treasury, I hope, and the Fed, I hope, will allow to fail, because not all the banks should stay in business. And I think Dick Herring will talk more about that later on. But let me tell you, these 9 banks are not going to fail. The Treasury is determined to keep them open. So it will work in that sense. But the larger question is, will it help the economy? And that's the question of whether or not these banks will start lending again. And that's the answer to that question. We don't know the answer. We don't know what's going to happen. What I suspect is the answer is, at least initially, no, they will not start lending again. And for that reason, I think we're going to have a fairly serious recession. How bad a recession? It's going to be a worse recession than the last time. It's going to be a recession with a lot of loss of jobs. Let me show you the latest consensus forecasts, private consensus as well as the IMF forecast for next year. For the United States, the European Monetary Union, UK, as well as Japan. The industrial world is going into recession. I personally believe, my colleagues may not agree with me, that the U.S. economy went into recession in September. Because the NBR looks at monthly data, and the monthly data for September were pretty ugly. But we won't know for sure until they meet another 12 months from now. In any case, it looks grim, short term. It's going to be grim for those of you on the job market. I think we're going to have to worry about just how deep the recession is going to be. And I'm waiting to hear from Jeremy what he thinks about that. It's interesting that we've done what we can, but the problem is the banks are impaired. Regardless of how much capital injection they get, they're impaired, and as a result, they will not be lending as much as they did before. And I think we have to face that. What will the job situation be like? Well, I can't tell you except to say that so far the loss of jobs has been minor compared with last time. Expect worse times ahead. This is the last recession. You can see in the rectangle is the actual timing of the recession. And notice that even after the recession ended in November 2001, we lost a lot of jobs after that. Some months we lost 200,000 jobs. So don't expect this job picture to turn around. Make your plans, make your placement plans accordingly to try to work around this terrible job markets that we're going to be facing. Maybe it won't be any worse than last time, but last time I remember Wharton students had a lot of trouble with the job market. I want to leave plenty of time for my colleagues, but I want to end with a political chart. Political chart. Where does that fit in here? Well, I want to begin by quoting the chief strategist of the Bill Clinton campaign in 1992. You know his name, James Carville. He's now famous. He actually believed that the economy was the key to the election. We were officially out of recession at the time, but it looked like we were still in recession, and most Americans thought we were still in recession. And so he forced the entire campaign to focus on the economy with a phrase, "It's the economy, stupid." And he hung the sign in the campaign headquarters. And in fact, I think that was the key to Bill Clinton winning the election. What about this time? Well, what I'd like to do is share with you the timing of the rebound of Obama in the campaign. And the way I'm going to do it is by using futures contracts. Intrade.com has futures contracts on Obama winning the presidency. The prices I'm going to show you are cents on a dollar. So if it's 50 cents on a dollar, it's a 50-50 race, okay? At the beginning of the week, when Lehman Brothers was about to fail, AIG was going to be taken over, and as I said indelicately, all hell broke loose in the financial markets. This was the price of Obama. It's a coincidence, of course. It's a coincidence that on September 15th, we reached the bottom of the Obama presidency, according to the futures market. And ever since that time, it's been up and up and up. Let me give you my interpretation, and my panelists can disagree with me. I actually think what happened is the economy turned very sour. The average American became very worried about the economy, and it's natural to blame the current administration for the economy. That's always the case. That was the case with Jimmy Carter's administration, it was the case with H.W.'s administration, and I think it's the case with the Republicans this year. So I'll end on this note. Isn't that a dramatic graph? There's probably some other explanations. Of course, there's more than one thing affecting the election, but you probably think it's because of all the other things in the election. Think at least of the possibility that the financial crisis is what is going to lead Obama to become the next president. Thank you.
You know, I agree totally with Dick on the Lehman bankruptcy on the 15th. And I think that's when we held the first panel, was right on that day, or the day before that day, day after that day, the day after that day. That was, and it turned out that is a hugely pivotal day. I didn't imagine how much Lehman debt was out there. I mean, I was shocked when, the bankruptcy courts finally, looked at it and, said something like, $800 billion worth of debts. Now, some of those were covered definitely with assets, but it just completely dwarfed anything else. A very important rate, Professor Marston mentioned, was the LIBOR rate. I'm not going to go. It's rather interesting that the rate is actually determined in London by the British Bankers Association by surveying 16 banks and their cost of funds over various time periods in various currencies, although the dollar has usually been the key one. Only 3 of the 16 banks are American banks, which has some significance also, J.P. Morgan, Citigroup, and Bank of America. LIBOR rates are huge in terms of basing loan rates to not as much as individuals. Individuals have prime rates, which are, it's quite interesting. The difference is more marked now. But in terms of commercial firms, industrial firms, big businesses borrowing at some spread over usually 3-month LIBOR, sometimes 1-month LIBOR rates. You have trillions of dollars of loans that are actually based on LIBOR. And oops, let me get over. And this is the graph over here. I don't know if this also has a does it have a there we go. It does have a laser pointer. This is going back a couple of years. Normally, LIBOR. This is the graph of LIBOR against the Fed funds target. I think it's more important. Richard talked about it against Treasury bills, but the Fed funds target is directly controllable, and actually Treasury bills have sort of disconnected also. And normally it runs 10, 15 basis points. This is pre-crisis. This was the crisis last year in August, again in October. It went outward. But then there was a period of 3 months where it stayed at a very stable 50 basis points above the Fed funds target. The Fed funds target was 2%. And the LIBOR rate was 2.5. Now that's a large spread, but it's a doable spread, and it was a very stable spread. This is September 15th, and you can just absolutely see what happened. The spread widened to 337 basis points. I bet if you ask any money manager 6 months earlier, could that ever happen? They say that is impossible. That could never happen, that you get that increase. Now, the significance of that increase is absolutely huge, because people's loans are based on LIBOR, and the spread is going up. When the Fed lowered by 50 basis points, as they did about 2 weeks ago in a concerted action of central banks, it was completely drowned out by the effect of the widening of the spread. So in essence, instead of, it did not have any effect of lowering the cost of capital to anybody based on LIBOR. It did have an effect if you're based on the prime rate, because the prime rate is strictly tied to the Fed funds target at 3 percentage points above the Fed funds target. So that moved in the right direction. But the LIBOR did not move in the direction. And this actually causes a situation that we used to only teach in history books, something called the liquidity trap. Because the liquidity trap, which goes back to Keynes, is even if the central bank lowers to zero, it is not low enough to induce either lending or borrowing. The cost of capital is not going down to the firms, and the central bank cannot go anywhere below zero. And that was really kind of scary in the sense that, my goodness, the Fed is moving and the borrowing rates are moving in the opposite direction. The only times we really had ever seen this before was in the Great Depression in the U.S. situation, and around the world, actually. Keynes wrote about it in the UK. And in Japan, after their bubble burst in 1990, and they actually also went down to zero rates and also could not get the banks lending. Now, I want to talk a little bit about the plan of action. The equity injections that were done under the Paulson plan and have been done in Europe. There's an old expression, you can lead a horse to water, but you can't force him to drink. You can give banks capital, but you cannot force them to lend. There's a lot of people who think the only problem with lending was that they were short of capital. Well, that was one problem, but not the only problem. The other problem was that they feared for the solvency of who they are lending to. You know, you could give me capital, you can give me borrowing rates at zero, but if I think there's a 10% probability the person I'm lending to is going to go bankrupt, I'm not going to lend to them. And I don't care how much capital you give to me, I'm not going to lend to them. I think too little attention has been paid to that question. I did remember Paulson went out and said, we want the banks to lend, you know, like, you know, that exhortation is going to let them make them lend. That's not necessarily going to be the case. Let me say something else, and then I'm going to go through a couple other things. When the central banks lowered by 50 basis points and that did not help, I think that really scared the equity market like it hadn't been scared in decades. The central bank is finally out of options, lost power. You can go down to zero, and that's not going to help. And that is kind of a panic situation because you always felt the Fed could come to your rescue. And what was happening with LIBOR rising at the same time Fed funds target was falling was exactly the opposite. Again, an absolutely unprecedented situation. I was actually proposing some other things that could be done and may still have to be done if the situation gets worse again. How about rebasing LIBOR to the Fed funds rate, like the prime rate is? The bank, maybe the Federal Reserve could go in and say, hey, if the banks rebase to Fed funds target instead of LIBOR, we'll guarantee the lines of credit, or some such inducement to get them to do so, and then you can guarantee the cost of capital is going down. Maybe back up interbank borrowing. Now, there has been some of that among the European banks, not really here in the U.S. One of the problems is banks fear other banks are going to go under, and that's one reason the LIBOR, which is the interbank borrowing rate, has gone up so much. The Fed could guarantee interbank borrowings to some extent and lower those costs. Guarantee private lending. The Federal Reserve has already set up a commercial paper facility, the first time in its history that is going to guarantee the smooth turnover of commercial paper to non-financial firms. It's never done it to non-financial firms at all. Remember, the broker-dealers and the investment banks were all classified as financial firms. Maybe the government will have to guarantee certain commercial paper and lines of credit. I mean, these are extreme measures. I'm saying there's measures that can, in fact, be taken later on. And then, of course, there's always the question of the stock market doesn't stop falling. You can always buy stock index futures. Actually, there is precedent. There are countries who have done that as a way to support the stock market. Now, obviously, if you're going to do any of the guarantee on lending, backing it up, you've got to take an equity position, and in fact, the Fed has taken equity positions in these infusions, warrants on the purchase of the common shares. But my main point is that there are other measures. These are emergency measures. I felt that people were falling into the chasm of the Fed is out of options, and there are other options, emergency options, the Fed, in fact, can take care of. I'm going to talk about the markets a little bit. Stock market and its valuation as a result of the plunge around the world. This is a Bloomberg screen. I just took it this morning. It is the PE ratios of the major markets around the world. And the final three columns, the third column from the right is the price-earnings ratio on the basis of the last 12 months of reported earnings. Current year estimate is on the basis of 2008 estimated earnings. Next year is 2009. The average historical PE ratio of the U.S. market is around 15. Just to give you a little bit of a benchmark on what the valuations are today. They are extraordinarily low. Now, I know earnings are going down, and I'm going to address that in just a moment. But as you can see, on the basis of the Dow, the S&P, 10-12 this year, and next year, NASDAQ is a little bit higher. The Toronto is 10-8. Mexican Bolsa is 10-9. Take a look at Europe. That's the middle grouping there. I've never seen Europe so low. The Europe stock 50 is 7 across the board, even when you do it on the basis of the last 12 months of earnings and going forward on earnings. And you can see markets is far down as 4 and 5 PE ratios. The last time we got down to single-digit PE ratios in the market was the 1970s. That was the last time that we had actually gotten down this low in the market. And we had a very bad situation there, because there we had a lot of inflation, and we had, instead of low interest rates, we had extraordinarily high interest rates, where someone could buy a treasury bill and bond and guarantee themselves 15% interest. Take a look at the third group in Asia. I don't know. I'm going to have to ask Dick Marston about this. I've never seen the Nikkei selling at 11 and 12 times earnings. It's usually at 25, even after the bubble burst, usually at 25 and 30. Hang Seng is 9, 10. The Shanghai Index, that Shanghai Index a year ago was selling at 55 times earnings. It's at 15 today. The S&P, that's the Australian index, 8, 9, 10, 11 times earnings. The Straits Times is the Singapore index. It's around the world. Now, what about the objection? Yeah, but we're in a recession, earnings are going down as fast as stock prices. Some people even say faster. I think we have to look a little bit at how you would value stocks. This is the quarterly earnings of the S&P over the last approximately 15 years. And well, this is the recession of 1991. This is the recession of 2001. Now we're in the downshift right over here. This is the regression trend line. People who talk about earnings going down have to remember, stock prices are not just based on the next 12 months of earnings. In fact, when you say that a stock has a 15 PE ratio, you're saying it's worth 15 times the ongoing earnings. Only 1/15 or 6% of a stock's price on average is the earnings of the next 12 months. 94% is after that. You have to look to the long run, unless you think we're going to be in a permanent recession for the next 10 or 15 years, which hasn't been the case. I have 3 minutes left. I will get done at that time. Let me just mention the red line over there is now at a trend line of $23. This is quarterly earnings on the S&P 500. So I'm kind of giving you the trend. This morning, the S&P was at 981. $92 a share is a PE ratio of 10.7. Now, based on normalized earnings, as I say, you don't often get down that low. That's an earnings yield of between 9 and 10% going forward. I think extremely attractive here. Now, let me give you a 40-year graph of the stock market. This is the S&P 500 over the last 40 years, going all the way back to 1970. It's a regression line with 1 and 2 standard deviations off the regression line. If you do, as I do believe in mean reversion and long-term stock returns, so that you deviate in the short run, but you eventually return to the mean. We see getting down to the green line in 1970s, 1982, which was actually at the bottom of the greatest bull market in U.S. history over the next 20 years. You also see, by the way, that in 2000, right over here in the bubble, we were above the 2 standard deviation and at risk. Let me mention that at the bottom, where we were 2 weeks ago, you see the fall off right there. We were 3.5 standard deviations below, never had been that low in the last 5 decades, below the mean. That doesn't guarantee that you're going to get back there that fast, but certainly it is saying that unless our economy is permanently going to fall apart, which I don't believe is going to be the case, and we can talk about later about whether how long-term and serious this is compared to the 30s or even the Japanese situation. The case for equities is pretty persuasive. And let me say one last sentence. I think we all recognize Warren Buffett as a great investor. And there's not very many times that an ordinary investor can buy a stock that he buys at a price cheaper than he bought. But about 3 weeks ago, he bought into General Electric. He bought into Goldman Sachs and took warrants and options on that at strike prices that are above the current price of those 2 stocks. And which means the ordinary investor can now actually get into the market, even as it's risen, and it's up about 10% or 15% almost from its low, at a price that Warren Buffett got in at a higher price. So he has a long-term look, and he thinks they're as low as they were in the 1970s. I say they're as low as they were in the 70s, if not even lower, and are attractive for investors. Thank you.
We know we're in a little bit of trouble when Jeremy quotes Keynes favorably, and so, but I agree with him that stocks are probably at this point not a bad investment for the long run. I'm going to shift the focus a little bit more towards thinking about government regulation and how people behave in this current market. And I don't have any overheads for my little diatribe here. And so, but let me kind of start off with some modesty, and that is we're in many ways all shooting from the hip here, and so there's lots of information that's kind of unfolding over time, and certainly I'll likely recant 30% of what I say within 6 months from now as more information gets released, even by next weekend. But at this point, like an academic, I'll speak with great force and pretend like I have great authority and know what I'm talking about here. In terms of, let me go through basically, I think, 3 points here that I'm trying to cover. First is I think people do, in fact, contrary to what a lot of economists will say, act stupid even when their own money is on the line. So that's kind of my first point. And so in many ways, I'm a traditional rational expectations economist, but I think people do, in fact, make fundamental errors, and I will go through some of that. But whereas Joe Stiglitz and others would trace these problems to principal-agent problems within the firm, I'm going to argue, and therefore he would argue, for more government regulation. We need government regulation to protect people from themselves and their mistakes. I'm going to argue just the opposite. I think government regulation, in fact, is encouraging people to act very stupid. And government regulation itself, instead of we thinking that we need more government regulation, we ought to really be rethinking a lot of the government regulation that we currently have. And that's kind of wrapping up with my third point. Whereas where a lot of people are calling for more government regulations, I'm going to argue that bad regulations are actually much worse than no regulations when people understand their own assets are on the line. So only the first point about people acting very stupid. I think the usual belief in economics, of course, is people are rational. I basically agree with that. Because if people are really dumb, then smart people can come along and arbitrage away their money and figure out how to take their money from them. And that's not going to be some people who last and sustain for a very long time. The last big mistake that the market supposedly made was in the year 2000, and after the dot-com bust. And it was actually not clear that people, investors in the year 1999 with high PE ratios were actually, in fact, making a mistake, that they were actually being irrational at that point. In particular, one can always tell stories about how bubbles are really not bubbles. Some people even defend that the Dutch tulip bubbles were not really bubbles, that there were reasons behind it that made total sense. I'm not going to go that far, but if you believe that the 2000 dot-com bust was so easily predictable, lots of those assets were publicly traded. You should be shorting those assets and made a lot of money. So I think lots of claims that people make after the fact that the 2000 problem was largely foreseeable is just kind of ego and a lot of hindsight. But in the current market, I think lots of the default rates in the current situation were, in fact, very foreseeable. It was well known at the time lots of the loans were going to reset, and in particular, given the underwriting standards that evolved over time with no-doc loans, with negative ARM loans where people aren't even making the full interest payments, that a lot of people were going to be in really bad shape. And in fact, I was first made aware of this problem a couple of years ago, spending lots of time in the San Francisco Bay Area. A lot of my friends were telling me about these great deals that they're getting on their mortgages. And with the 3- and 5-year resets where the interest rates suddenly go up. And that would be kind of giving them little warnings and saying it's kind of crazy, you can't really afford that. What's going to happen in 3 to 5 years? And they'll say, oh, no, there's no problem at all. Even if I have to sell in 3 to 5 years, of course I'm going to make a big capital gains. And, I'll be making a lot of money. Maybe I'll find a place I can actually afford. Now, that's not a bad strategy if you're the only one playing that game. But if everybody's playing that game, that's obviously a fallacy of composition. Prices are going to go down. But the difference between now and then is that it's a little harder in the subprime case for smart people to clear the market as easily. In particular, what's true, some smart people took bets in terms of the subprime problem, and there's some limited trading instruments, and it's also true lots of the banks could have issued fewer asset-backed securities. It's hard to directly short another person's home price. In particular, in other words, if I think your home price is too high, there's not much I can really do about it to short that price. And yeah, there's other instruments I can trade that are correlated with that risk and that I can maybe make some money off that. But there's no reason to believe that home prices overall we're going to be efficient, that there is some market clearing mechanism. And so lots of the asset-backed securities, the CMOs and others, were basically pooling these loans, and it was well known that they were highly leveraged and exposed to even very small default rates. And they allowed equity holders to make loans on borrowed money and sell off the loans, make more loans with proceeds, and so forth. So banks and brokers became originators of debt, but they are no longer bearing the risk associated with the underwriting. And this leads to an obvious moral hazard problem whenever you divorce the underwriting from the risk-taking. At first glance, you would wonder why would anybody buy these packages of securities, given that they should be hugely full of junk, given that people who are underwriting aren't bearing the risk. Well, this is where the rating agencies came in. The rating agencies were supposed to be the control for moral hazard. In particular, junk stuff was going to get priced lower and because it got a lower rating. Better stuff would get a higher rating, and therefore priced better. The markets were supposed to be efficient again. So the rating agencies played a very crucial role in all this. But what they basically did is that they rated too much based on what's called the preferences of the underlying securities. That is, they would divide these things up into different tranches and basically say, if you're first in line, we'll give these a AAA. If you're second in line, we'll give this a little bit of lower rating, and so forth. That strategy, that trick usually works pretty well when you're talking about stuff that's a lot of risk subject to firm-specific risk. But it doesn't work so well when we're talking about stuff that's heavily based on systemic risk, and where it doesn't really matter if you're first or ninth in line. And the fact of the matter is S&P and Moody's, the two main rating agencies, had pretty lousy models. And certainly there will be a lot of discussion about how they face conflicts of interest and how they are paid and so forth. Economists would generally argue that they care about their reputation, that conflict of interest should not be such a problem. I think there are issues there. But a central mistake that investors played in all of this was that they were trusting the rating agencies way too much. There are endowments, pension funds, and many others who basically looked at these asset-backed debt, said, hey, they're the highest rating, not really understanding why they were paying 100, 200 basis points more than the other AAA ratings, and so they would buy this stuff. And the rating agencies really just played the role of providing cover, and they were more than willing to do that for a price. Going forward, there's another crisis emerging. It's much bigger than the subprime one, and that's the entitlement problems that the United States face in terms of our Social Security, Medicare, and Medicaid programs. You think that $1 or $2 trillion that the government will spend on this subprime mess, that's a lot of money. We face a present value shortfall in those entitlement programs of about $70 trillion, a much bigger problem. So a train wreck is coming. The subprime mess is not the train wreck, but it's more like an appetizer, to mix my metaphors, for a much bigger train wreck that's on its way. And right now the rating agencies are once again doing a lousy job by looking at simply explicit paper debt that's printed and not looking at the implicit debt. The second main point I want to get across is that I actually think instead of saying people are myopic, we need more government regulation itself is a cause of lots of myopia. In particular, I think instead of thinking about government regulation meaning to save people from themselves, we ought to think about how government regulation really gives a false sense of confidence and relaxation. 5 examples really quickly here. The first one is mortgages. Freddie and Fannie were always a ticking time bomb. It was obvious that this problem was going to happen. Why? Congress basically used Freddie and Fannie and as well as other community development programs to try to increase the amount of homeownership. Somehow homeownership due to neighborhood network effects was a good thing. We wanted to promote this thing. The problem is Fannie and Fannie were technically private market vehicles. And they were privatized some time ago. They weren't explicit obligations to the U.S. government, but it was well known that they were moral obligations. The federal government would come in. Members of Congress talked about this. And that's basically the worst possible setup that you can have. A private entity out there that has an implicit guarantee associated with it, but you have no way of controlling its behavior. You're just begging for lots of moral hazard. There was nothing that was being priced into their actions. The way to think about regulation, it's like a good game of tennis, a good play of tennis. In tennis, you want to play aggressively at the net, or you want to be pretty relaxed and play at the baseline. You never want to play in between. And regulations really have to be that way. Either you're going to be aggressive, you're going to do it right, or you're going to play at the baseline and be pretty minimalistic about it, but you don't play in between. And this is a clear example where the government's playing in between and everything got screwed up. California saw it the same way. I was teaching at Stanford at the time. California decided to deregulate electricity, but they didn't really want to deregulate all the way. So they kind of went halfway in the middle. And so, because they wanted lower prices, but they still wanted government control. What did we have? We had rolling, I was in the gym multiple times, the lights would go out. I mean, rolling blackouts and so forth, because the government regulation wasn't at the net, wasn't at the baseline. Another example of poor tennis play was basically how the FDIC works, following the deregulation of the Glass-Steagall Act in 1999. In particular, the FDIC, of course, you know, guarantees banks' deposits, and it requires, therefore, bank reserves, and which is a function of the loans that are outstanding and made. But after the deregulation, banks were able to take off some of those loans off its balance sheets with securitization. They were able to reduce the amount of assets that they needed to hold in their balance sheets. But using complicated transactions, they were still fundamentally exposed to a lot of the risk. And so the bottom line there is, again, the government has this guarantee. It's not properly regulating. It's kind of plain, again, in the middle. I also think the government screws up in how it validates rating agencies. In particular, federal government rules around commercial paper, money market accounts, and so forth give a legal authority to select national rating agencies, S&P, Moody's, and I think they just get too much government backing, too much validation. The fact of the matter is rating agencies stink. Moody's stinks, S&P stinks. They basically are good at predicting insolvency risk about 24 hours before it happens. They basically are terrible in predicting insolvency risk at the time dimension that's actually useful for writing contracts. And why would you give such validation to such incompetent institutions? And so I think we should really have more capitalism in this area, more information, being exchanged, and certainly allow more contracts being designed on more sources of information. And speaking of information, I told you I was going to be in my soapbox. Sarbanes-Oxley. Sarbanes-Oxley, I think, is a bill. I was part of the administration when we wrote that bill. It gives a tremendous source, a sense of a false sense of accountability and a sense of accomplishment. It has whole provisions on risk management, but the provisions of Sarbanes-Oxley for risk management are extraordinarily weak, and they really provide nothing other than a false sense of confidence. I agree. In my last example here, I agree that September 15th was a big day. But I also want to say that just don't look at the reduction in stock market prices and say there's a role for government here. I want to turn it around and say government plays a role in causing some of those things too. Treasury and the Fed itself, I think, produced a sense of urgency that was interpreted by the market as having some inside information. Keep in mind, as Jeremy pointed out, markets are forward-looking. I was also often been asked by reporters during the last couple of weeks, was Lehman and AIG, were they really all in that bad of shape? And my honest answer is, I don't know. Because the thing about these 144A placements and other contracts is that we really don't know their exposure until they declare bankruptcy. That's kind of the irony of all this. We don't really know how bad in shape they were until that happens. I think Treasury and the Fed played a kind of a role of a signaling. By saying there's a big urgency, there's a big problem, the market said they have inside information, and there must be a big problem, there must be an urgency here. And so did they do the right thing? My inclination is maybe they did do some of the right thing, but don't simply look at stock prices and say we needed government intervention. Sometimes government intervention creates its own need. And we need to, in fact, ask ourselves, and these are some of the comments I might be amending in 6 months as more information comes out, but we can't just simply assume markets are bad, therefore we need government. Sometimes it can also work the other direction. So in the last 2 minutes, let me ask the question, so what do we need to do going forward? And there will be certainly lots of, especially with the new Congress and new presidents, trying to discuss. And their first inclination, in fact, the writings on the wall, everybody's talking about we need more regulation. My first suggestion is let's first pause, stop, and really have an open, honest discussion. Some reasonable steps, obviously, can be taken. We need a balanced discussion, but we also, part of that discussion is not what more rules to add, but looking at the existing rules and how they contribute to the problem. Sarbanes-Oxley is an example of regulation that was done in a very reactive way and that probably in many ways caused more harm than good. Many of the provisions of Sarbanes-Oxley only reward accounting firm and law firms. Many, what I call legitimate firms, that doesn't include law firms, now list on the London AIM precisely because of the enormous complexities that Sarbanes-Oxley caused, especially for small and mid-cap firms. And Sarbanes-Oxley also creates, I think, an enormous sense of security. And there's a lot of parallels between these events today and then. I was at Treasury Minister at that time, advised the Federal Open Market Committee and the Financial Advisory Regulatory Panel at the time. Congress had other ideas, though. They had to make a statement. So first, they issued a subpoena of my inbox, including every email that included the word Enron and other people in the administration's inboxes. But then they decided, well, we really need to pass this very tough law. This law, Sarbanes-Oxley, was very reactionary, and it was overstepping at the time. The logic that we had, though, was that it was okay to go too far. Because what we could always do if we went too far is we could always unwind later. It was better to be safe than sorry, was what we kept on saying. And so what we have now is we have a law that has very high complexity, very high compliance costs that clearly hurts, in my opinion, shareholders of small and mid-cap firms in particular. And it's not true that it's now easy to unwind those parts now. And the reason why is because once you make a bad law, a whole cottage industry of accountants and legal firms endogenously is created to support that law. And they hire lobbyists, and they argue for continuing that law because that's how they get fees. The small mid-cap in Minnesota doesn't have a chance. And so we're not going to see much unraveling of Sarbanes-Oxley, even though it clearly was an overreaction to the problem. So I'm afraid of the same type of overreaction happening today, and we need to be, I think, very careful. And 15 seconds, I think one thing I would do is I would impose, instead of having Congress design a law like with Sarbanes-Oxley, let's create a panel of experts, much like we did when Congress couldn't actually pull the trigger and require the expense of the stock options. That was too political. You had too many people from blue states who are supposed to be anti-business, but in this case they favored bad accounting. And so what Congress did is they set up a separate panel that actually eventually did it. Sometimes we need to have that cover. And so my suggestion is that we be very suspicious of anything that Congress rushes out after the first session next year. And we need to proceed very carefully and with great purpose. Thanks.
Well, it's probably not optimal to follow four-star speakers. So I'm going to be doing a lot of editing on the fly. I guess I would add one even more depressing detail to Ken Smitter's speech. The Glass-Steagall Act, you may recall, was passed in the Depression, the early days of the Depression, in fact. And after a mere 2 years, Senator Carter Glass went to the floor of the Senate and recanted and wished that they would, in fact, roll it back. Well, it didn't happen until Gramm-Leach-Bliley in 1997, so it can take a very, very long time to unwind bad legislation. What I'm going to do is take you through a lot more rapidly than I had meant, because a lot of this material has been covered, but I wanted to give you a little bit of the background of what I saw as a cause and why I'm so concerned about what the consequences may be. Securitization was, as many people have mentioned, actually modeled on the actions of the government-sponsored entities. Even before they were government-sponsored entities, they were in fact government enterprises. They were spun off by Lyndon Johnson, who wanted to pay for guns and butter, and thought if he could put these entities off balance sheet, which Congress has certainly liked, then he could have his policies and not pay for them. And that has been a winning solution with Congress for a very long time. Well, when you thought about how you would replicate that with private securitizations, the key challenge was how you substituted for the government guarantee against credit risk. You had to have some means of making up for the fact that the government was not going to guarantee private securitizations. And there were essentially three ways of doing that. One was to develop very good statistical models that would tell you how much of a buffer you had to create in order to make some of the securities in a securitization equivalent to AAA, AA, whatever you liked, but usually investment-grade risk. This was also buttressed by ratings from the statistical ratings organizations, Moody's, Fitch, S&P, as we've heard, and Kent's judgment of their performance, I think, has certainly shown up in recent times, although they've really done a rather good job on corporates until very recently. Although he's quite right that they're never ahead of markets. It's always a lag and never really forward-looking at all. And then finally, if you were really, really worried, you'd want to have some monoline insurance backing up the credit risk so that you could be very, very sure that your security was actually worth what it was rated to be. The result was an absolute explosion of innovations. We had RMBSs, CDOs, CDO squareds, asset-backed commercial paper, SIVs, SIV lights, and it went on and on. And we developed a huge off-balance sheet banking system, private, that amounts to about $11 trillion. It helped feed what was a regulatory-induced, and this sort of feeds into Kent's story as well, a regulatory-induced demand for very high-quality assets. The regulators, in many cases, required institutions to hold at least investment-grade and sometimes AAA-rated securities. Well, it turns out there are not that many AAA-rated corporations in the world. And so by securitization, you could synthesize AAA-rated securities by essentially developing a structure that would give you the equivalent in terms of default. That was used even with subprime mortgages, where no one of the mortgages would have been remotely labeled AAA, but through the magic of securitization, you could easily transform as much as 85% of them into AAA. This just gives you a quick overview of the structure, but it could get hideously complex very quickly. I took it out to CDO squareds, where you're taking the lower tranches and retranching them, but noticing each time you're ending up with some AAA tranches. And I could have gone out to CDO cubes, but that's enough to give you an idea that the people who are buying the end products either had to do a hell of a lot of homework to find out what was underlying it, or simply were just looking at the ratings. It became a very, very important source of income to LCFIs is the kind of language that the Bank of England and IMF use for the most important banks in the world. There are about 16 of them. And you can read the Puce and Chartreuse blocks as being a sort of proxy for the fees they were making on securitization. So it became a really important source of income. And it's one of the reasons we've seen investment banks collapse so readily. They were so dependent on this source of income, which has dried up and may have dried up for the foreseeable future, that they really are going to have to reinvent themselves. All of this came to a halt when they were confronted with the brute fact that they were really dealing with assets that weren't nearly as good as they thought they were. Keep your eye on the left screen if I could figure out how to use the, but I can't. Anyhow, take a look at the subprime section. We should have a laser pointer that I haven't really quite figured out, but the blue was thought to be the worst that could ever happen. 2000 was just before the recession. In this kind of lending, for reasons that Kent described, you expect the peak default rate to be about 3 years after the loan was issued, because in subprime lending, the custom is to give a teaser rate that's very, very low, and then at the third year, you jump it up, sometimes with a 400 or 500 basis point spread above LIBOR. So you go to from a very, very low rate to a very, very high rate after 3 years, and that's where you expect to see peak defaults. The idea was not that anybody was ever going to pay those high rates, but that house prices would rise so rapidly that by the time you got to that point, you could refinance and keep going. And that was in the context of what was basically 75 years of upward price movements. Well, notice that in the more recent vintages, 2005, as Dick Marston pointed out, was sort of a turning point that nobody seemed to recognize. 2006 and 2007 especially, you were seeing delinquency rates that exceeded the peak rate that you thought was the worst possible within months, which meant that some people were walking away from their houses without ever having made a payment. That led to a breakdown, and it was very clear that there was a huge breakdown in underwriting standards at many different levels, and it undermined the three pillars that were the foundation for support for private securitizations. And that was statistical ratings models, ratings agencies, and monoline insurance. All three collapsed. First, the ratings models. The institutions that had the strongest incentives to build the best models were those that were underwriting the most of this debt. And they were also the institutions that showed the largest losses and showed them first. And they showed them repeatedly, which indicated that not only did they not get it right the first time, they couldn't get it right the second or third time either. Bear Stearns, which was one of the leaders of the pack, had two hedge funds that blew up. Citigroup, Merrill Lynch, UBS, on and on, had repeated write-downs that were basically because they hadn't modeled things appropriately. Then it came to the ratings agencies. Well, people were accustomed to thinking about corporate ratings. The very worst year in corporate rating history was 2001. The yellow represents three-notch downgrades, which is pretty severe. But notice that in the corporate world, 2001 being where we lost Enron and WorldCom, there were really negligible three-notch downgrades except in the below investment grade range, which everybody knew was very volatile and was not very surprising. But look at what happened in the 2007, 2008, and it's I guess, of 131, 2008, to the subprime-backed securities. Look at the BBB category in particular. 68% of those were downgraded three notches, which took them from investment grade to below investment grade, which meant that many of the institutions that were holding them had to get rid of them. Now, you might think, looking at this, that they did a much better job at AAA, but it simply reveals a flaw in the way in which they approached it. In these nested securities, you had to sort of start at the bottom and work up until you got to the AAA to know just how bad it was. These have now been selling for 50, 60 cents on the dollar, and so they didn't really fare much better. And as soon as monoline insurance looked like it was going to have to pay up, the stock prices of monoline insurers collapsed, and the credit default spreads went up to 1,000 basis points. The IMF has something very clever called a heat diagram that shows how quickly the crisis spread. And in this diagram, it's good to be green. That means you're within one standard deviation of the way you're usually priced. If you're yellow, it's not so good. You're within 1 to 4 standard deviations of the way you're usually priced. But if you're red, it's really terrible. You're being priced within 4 standard deviations of the normal. And what you see is the pattern of exposure. It began with subprime, and it really began, Dick noted that one really should have known about it in 2005, but it was completely unambiguous in February 2007 when HSBC made a full account of its subprime losses in its American subsidiary, Household Finance. And if you kept dancing, as Charles Prince did after that, you were simply not paying attention, or you had a very severe case of cognitive dissonance. It spread to banks. It continued, of course, with subprime. And then, as we found more and more banks were involved, banks and other financial institutions became involved. Then all sorts of instruments that relied on the 3 pillars of privatization. Either they relied on ratings, or they relied on monoline insurance, like municipal bonds, or they relied on statistical models for their value. For a long time, there was a discussion of decoupling, that the emerging markets were going to be able to manage on their own, that they had self-sustained demand, and you had China and India that were sort of leading the way, and I think Jeremy's shown you how that's unfortunately ended the wrong way. It should have been apparent in August 2007 that this was a crisis of decapitalization. There were major losses that were absolutely apparent, although not revealed. And there were losses because of holding some of these securities. Some of these institutions were dumb enough to eat their own cooking. And there were losses from honoring implicit guarantees that were backing up off-balance sheet commitments to this whole private system of off-balance sheet banking. There were also losses of pipelines of assets that could no longer be taken to the market and securitized. That was basically the Northern Rock story. And as we saw, it was a very important source of revenue that simply had disappeared from future earnings, which is one of the points that Jeremy was making about how you think about what a price of a stock should be. The capital challenge was not only to replace it, and Dick showed that they've really not been keeping up with the amount they've had to write down, but it was also stockpiling capital, and that's one of the reasons the recovery is usually so slow, because the market starts to demand a whole lot more capital than regulators do. And the unknown, of course, is how much of the off-balance sheet stuff is ultimately going to have to be brought back on the balance sheet. The variations in disclosure across countries have been very harmful because this is an integrated global market with very different disclosure practices. The SEC requires quarterly disclosure. Europe is more principles-based, less prescriptive. The CFO can exercise professional judgment about the scale and timing of loss recognitions, which is one of the reasons that you saw a lot of schadenfreude in Europe until they all panicked in August, because they took their time in letting out the bad news. But the upshot is that the same asset can be valued quite differently in different institutions. The piecemeal release of increasingly larger losses was a really bad strategy, if indeed one could call it that. It raised questions about the integrity of financial reporting, and it really, in the end, raised questions about whether management understood its own risk positions. The Fed, I'm not quite sure what happened to our framing here, but the bailout of Bear was where things got really panicky. And it's because the Fed was really afraid of submitting what they considered to be a very large, very opaque institution that they had no oversight of to the process of resolution. And the reason is that one of the common tools of bankruptcy courts everywhere is to exercise stays. And stays can be fatal in markets that trade literally 24/7, where people have to worry about their positions and how they're going to end up. So the real concern was that it could have fatal damage to the primary dealer market. Well, in the meantime, the government managed to bail out Freddie and Fannie, and when it got to Lehman, a number of people thought it was obvious that they would have to bail out Lehman because Lehman was at least twice as big as Bear and probably much more complicated. And indeed, if you're talking about the deserving and solvent, Lehman had actually tried harder than Bear to keep itself from the brink. But they didn't. In the wake of the Fannie and Freddie bailouts, they seemed to want to show that there was some limit to their willing to subsidize. And the Fed had examiners in all four of the remaining investment banks daily since then, and felt they could predict what the consequences could be. Unfortunately, they didn't. They didn't realize that it was held by major money market mutual funds. They didn't realize that Lehman had commingled customers' money with its own money in London, where lots of hedge funds were relying on access to their prime brokerage accounts and couldn't get it. And so that is, and I think I've agreed with all the panelists, that was really the time that things turned to terror. By an intervention policy that seemed increasingly ad hoc and desperate, you saw that central banks were, you could argue if you were trying to make the best possible case for the central bank, that it was their old favorite policy of constructive ambiguity, which I've never believed in. But I would argue instead it was really destructive ambiguity, because nobody knew who would be next. This is a cartoon from The Economist that is, of course, the Humpty Dumpty fairy tale, and one of the king's horses and one of the king's men is saying it appears this is having a fairy tale ending. You may remember it didn't end well for Humpty Dumpty. You can see AIG teetering on the brink, and at the rest you see Fannie and Lehman and so forth, with the soldier behind Lehman saying shares in glue should be rising high. But there was terror throughout the market because you really couldn't predict what the government might do next. Markets react really negatively to uncertainty. You had a massive flight to quality and to simplicity. There were huge outflows from what some people believe are the safest of funds next to Treasury bills, institutional money funds. And we saw that the Reserve Primary Fund and Putnam Fund actually had to close. And that led to real terror in the marketplace. It was a loss of confidence in the financial system. The punchline there is, can I interest you in a faith-based deposit? Which began to show signs of panic, where you have a man here saying, give me all my money or else, to a situation where banks became increasingly desperate for liquidity that you began to see in interbank markets with huge markups. Now, I would have a disagreement, I think, with some of the interpretations you've heard of the interbank rate spread, but we'll hold that till later. This is simply showing how incredibly innovative the Fed has been, taking all sorts of collateral from all sorts of people for all sorts of terms, without, until very recently, having much impact at all on conditions. And I think it's fundamentally because they were trying to deal with what was really a solvency shock, and should have been apparent as a solvency shock, by supplying more liquidity, and that just doesn't work. This is what's happened to the Fed's balance sheet. Notice that it's almost doubled, and it's still going up, because just today they announced they were going to have a new facility for money market mutual funds. More broadly, the problem has been excessive leverage, and it's been mainly centered in the household sector and in the financial sector, where it's really quadrupled. With a year's inventory of unsold homes, it's inevitable that we're going to have larger losses and more deleveraging. Deleveraging has had all sorts of financial institutions, even hedge funds, where you can see the green line going down precipitously. It has even hit Main Street, where what used to be the friendly loan company has become the go-to-hell loan company. And sadly, as we all know, it's hit the financial sector really, really hard. And it's not just the financial sector, it's others as well. The problem, of course, is that the Treasury insisted on interpreting this as a liquidity problem as recently as the TARP fund, with this bizarre $700 billion program to buy toxic assets. There's another cartoon that I skipped that showed them burying them. And it was a bizarre political gesture. For some reason, they seemed to think it would be easier to sell as buying toxic assets from the people who owned them and had created them than to talk about actually doing something for homeowners or for rebuilding the institutions. Congress originally rejected it, but when Ben Bernanke told them that we wouldn't have an economy if they didn't pass it, they came up with something. In addition to production for makers of wooden arrows and rum, and a monthly subsidy for bicyclists, they actually came up with some pretty good programs. And one of them is the Treasury that can now invest $250 billion in bank preferred shares. 125 of it has already been allocated. The remaining 125 has to be applied for by the middle of next month. The Fed can purchase commercial paper now, starting October 27th, which is a market you could seriously think about making more liquid. There's no way to revive the market for junk securities, and so that was misguided from the start. The FDIC has also been hyperactive. They've raised insurance to $250,000 on regular deposits from $100,000 with utterly no discussion about it. They've offered unlimited deposit insurance on non-interest-bearing accounts that businesses hold. And they're also going to start guaranteeing subordinated debt for 3 years. So if there was ever any hope of having market discipline in the system, it's pretty much gone. The European, this gets cut pretty badly, but it should say the the European Union has acted with surprising speed and deceptive unanimity, and you can see the kinds of bailouts they've been doing. It looks the same, but it's not quite the same. This has sort of led to a worldwide round of coordinated government guarantees and subsidies that have made moral hazard really rampant and have really, I think, made it very difficult to see where we go from here. Punchline here is now we just have to sit back and wait for the Fed to bail us out. Well, where are all these ad hoc measures taking us? Deep government involvement in the banking system, and there's really no sense of how they're going to exit or any vision of where they should be going. You have quasi-ownership of banks with very few protections for taxpayers. The U.S. is pouring in preferred stock, but with no cost to existing shareholders, and no push to write down or actually reveal the bad assets, which the Europeans at least have done. We're ending up with a tiered banking system where the 9 favored banks are like GSEs, with all of the problems that we faced with the GSEs and very few of the controls. And the liquidity programs have basically been nothing but forbearance. They've been putting off problems that have been growing, not shrinking. Housing finance is an open question. Nobody knows how we're going to do it in the future, but it's very clear that the government's playing a bigger and bigger role. And it is going to be a bigger and bigger liability on the government's balance sheet, which could, in fact, ultimately affect its ratings. One of the key questions is how far house prices will fall. The average, we have some reason to believe that there's a third wave of defaults on equity loans and prime loans, and then the real economy effects are just sitting in. Luckily, we're sitting on a market that's not nearly as bad as most people think. Actually, 25 million people have paid off their houses, and 55 million have mortgages that, and of those, 51 are paying on time. It's really only 4 million that are behind, and only 2% of those are in foreclosure, as opposed to 50% in the Great Depression. I think one of the key questions is how you restore faith in securitization, because private securitization amounts to almost 12 trillion. And there's just not enough capital in the world to put that back on institutions' balance sheets. So we have to think of some way to make it more transparent and more possible. And as you can see, new issues of private securitizations have virtually disappeared. The key policy challenge, I think, that really nobody has discussed, and Marty will be glad to hear these long-awaited words in conclusion, I think the really, really tough problem facing us all is trying to figure out how we can make the world safe for even the largest, the failure of even the largest, most interconnected institutions. It's not beyond possibility, but nobody seems to be working on it.
In terms of remedying the economic situation, yesterday Chairman Ben Bernanke came out in favor of additional fiscal stimulus. Do you think that's appropriate at this juncture? It unleashed a rather harsh response by Wall Street Journal today, actually saying that this was akin to his endorsement of Obama, and that he should have, in their words, begged off of any pronouncement on the fiscal side. In fact, even stating that prior to past elections, Federal Reserve Chairman would even beg off of even exercising monetary policy. So should he have begged off, and what should, in your view, be done in the area of either fiscal or monetary policy?
Well, let me comment that I think he could be right. I think fourth quarter looks horrendous, the one we're in. The estimates for GDP growth are now -2 to -3 for this quarter. That's one of the sharpest declines, I think, since Carter put credit card controls on. Maybe it's too late to get a tax refund to boost holiday spending. That's what you'd really like to do. It did seem to work in the second quarter, when we had a fairly decent growth on GDP, but I don't know whether we could get it in the hands of consumers fast enough. Anyway, that's my opinion.
I actually agree with Jeremy, but let me say that I don't think the Fed chair should talk about fiscal policy. I think Greenspan was wrong to talk about, endorse the Bush tax cuts. Didn't quite endorse them, but he certainly encouraged them. And I think Bernanke should focus on monetary policy. The central bank really has to keep credibility with respect to bank regulation and monetary policy. And there are enough other people who can talk about the need for a stimulus package. But I agree entirely with Jeremy that we need a stimulus package sooner rather than later. How it's designed will be a different issue. But I expect that as soon as the election is over, the Congress will be back in session and we'll have something on the President's desk very soon. The President may not like it, so it's a question of compromise to see what they actually do in terms of what to stimulate. Just sending people $1,000, an awful lot that doesn't get spent. So perhaps we can do it a little more imaginatively this time, but I think there will definitely be a stimulus package.
Yeah, I don't think you need to count on the chairman of the Fed for encouragement to Congress to spend more money. And I really do take Dick's point very seriously. I think the Fed's credibility is enormously important, and I think they're really in danger of losing it. A lot of the reform packages have talked about giving them oversight of the entire financial system, and de facto they've more or less assumed it. But the regulatory record is spotty at best. It's certainly uneven. It's unpredictable. They've not done a good job of explaining what they're trying to do. And if they really were the architects, as one has heard, of the TARP plan to buy that toxic debt from the people who created it, I think there are real questions about whether they don't have enough on their plate already to
Did you think the Fed was the architect and not Paulson?
I had heard that was the case.
It sounds like a Paulson plan to me.
Well, I think they both have to agree before they go out. But I have been to seminars at the Fed where people go through exercises where they believe that they can actually price the stuff. And the assumptions you can, if you're willing to make assumptions about future cash flows and the appropriate discount rate, but the range of those assumptions can be huge. I think that if they did not actually set out the plan, they certainly gave him encouragement by indicating that the
Well, Dick, now we know it's the Paulson plan because he clearly didn't know how to price this stuff.
He's outsourcing it. He's outsourcing, and he has friends who do that for a lot of money.
I guess I would just make 2 quick points. I think the real issue that we have to face as a long-term economy is that we are in dire need of fundamental tax reform. And the problem with doing a little rebates here, a little rebates there, is it postpones the big discussion. We have some of the highest effective tax rates in capital income in the world. We need fundamental tax reform, and we use up our black powder when we just send up rebate checks. I think we need to have a serious discussion, go beyond the simple short run. Let me push back on the panelists on one point too, and that is this idea of credibility of the Fed. It's not obvious to me that that's so important, and I realize that I'm saying something that's completely the opposite. But one way you could think about, credibility, it's predictability, and that predictability can sometimes lead to moral hazard. I think sometimes this idea of a mixed strategy where the government is less predictable about who it's going to bail out and how can actually have some feedbacks on dealing with moral hazard. And so I think the fact that it let some banks sink and some banks survive, people are criticized and saying, well, that's a terrible thing, it was inconsistent. Not obvious on an ongoing basis, that's really the bad strategy. Because now when I'm a bank and I can do stupid stuff, it's not obvious if I'm going to be the one bailing out, getting bailed out or not.
Oh, I absolutely agree, and that's why I think the policy of constructive ambiguity is fundamentally unworkable, because we usually can predict, and we in fact have a very rigorous system for figuring out which banks we should bail out and which we shouldn't. And what's distressing about the way all of this has happened is that if we'd made the list of the 9 biggest banks 2 months before we did, it would have included Washington Mutual and Wachovia. And we have no reason to believe that the 9 on the list now are fundamentally that much stronger. In fact, if you want to see just how unreliable public information about these institutions is, think of the fact that just 2 weeks before Wachovia became insolvent, Morgan Stanley, one of the firms with the reputation for being able to value anything, was willing to sell itself to a firm that became bankrupt 2 months later. The disclosure that we have is simply completely inadequate for the kind of business these banks are doing.
Is there a question over on this side?
What changes would you anticipate in the hedge fund industry, both in terms of regulation as well as trading strategies or profitability?
I guess I'll tackle that. I think that's the big unknown in terms of whether or not the new regulations will be extended to hedge funds. There's some real difficulties in conceiving exactly how they would be regulated. It's an international market. So I think we'll really have to wait and see what happens with respect to regulation. There's going to be a lot of discussion of to what extent should the traditional banking regulation be extended to other types of financial institutions. I really personally doubt whether or not it will be extended to hedge funds. Let me be a little cynical. Who are some of the biggest contributors to the incoming administration? The real test of the administration with respect to hedge funds, which is going to be very interesting as far as I'm concerned, is it going to be possible to actually impose income taxes on the income earned by hedge funds and private equity partners? Under the current law, what happens is the income, not the capital at risk, but the income, the carried interest, is taxed at 15% rather than at the ordinary 35% income tax rate. An interesting question will be in the new administration, will they actually decide to tax the people who have donated so much money to them? That's going to be interesting. That's going to be a test, a litmus test of whether or not they're serious about changing the income distribution in the United States. My guess is they won't touch that thing, but we'll see. We'll see next year and the following year. Will the new administration tax carried interest at ordinary income tax rates?
I would add 1 point, or I guess 3 points to that. One, I think that leveraged strategies are pretty much doomed for the short to medium term. Prime brokers are much, much tighter than they used to be. It's very, very hard to leverage up in the way that hedge funds once did. So those that were relying heavily on leverage, I think, are going to be in a lot of trouble. On the other hand, I think hedge funds that specialize in distressed debt have just incredible opportunities before them and probably will do remarkably well. I guess I'm a little more optimistic that they won't be regulated, and I think the very fact that investment banks now are all nestled in more heavily regulated banks means that a lot of the top talent are probably going to leave for hedge funds, and hedge funds are going to end up being something like the new investment banks. Not with the scale, but with much of the innovation and much of the kind of interesting business that was once done by investment banks.
I think what's interesting is that, you know, a year ago people said what's going to explode if there is going to be an explosion. It was the hedge funds. They're, totally unregulated, $2 trillion of assets at their peak. And the interesting thing is they didn't. I mean, yes, a few of them have gone down, of course. But in general, now the aggregate returns year to date are down about half the S&P, which means their beta is about 1/2, which is a little bit higher than what they sometimes advertise themselves out. But if you take a blended average, that's not all, that's not all that bad. And really, there hasn't been that much finger pointing as one might expect at the hedge funds causing any of this, because they didn't. They did short things faster, which should go down and did go down to some extent. But outside of that, they've actually stayed pretty clean in this mess, I think.
Interestingly, the G7 meeting that preceded the one that took place just this last fall had labeled that as the main threat to the financial system. And if you looked at their involvement in this market, they were actually big buyers of the CDO equity tranches. So they were holding the riskiest pieces of these things, but they tended to do much better with them than the people who actually originated them. And the reason is that the hedge funds did their homework. They priced them appropriately, they knew when to hedge them, they moved them quickly, and you found other institutions were just really sitting on it.
Okay. Yeah. Question in the middle.
Yeah, sorry. In light of the current crisis and also the entitlement problems that Professor Smetters touched upon, what is the chance that the riskiness of T-bills will be changing in the future?
That the
riskiness of T-bills, that the Treasury bills will be changing.
What do you mean by the risk? There
they
is never
won't be
any risk on the
risk-free.
T-bills.
That they won't be risk-free anymore in the future.
But they only promise to pay Federal Reserve notes, and there's an unlimited supply of Federal Reserve notes from the Fed. So there cannot be any risk.
I guess the question is about the
bills. He means bonds. He means the longer term.
It doesn't matter. There can't be any risk on that in nominal terms either.
Well, nominal terms, yeah, sure.
Well,
We're
then you're talking about
real
risk
terms.
of inflation. Okay.
Yeah. I mean,
Okay.
that's the real.
Well,
risk.
then that's the question.
I mean,
so I guess the question is about the default of the U.S. government in the most.
You're talking about a hyperinflation or a massive inflation of some sort.
or explicit default.
Well,
Both can happen.
I mean, there's no way they're going to default on the nominal debt. They might default on the TIPS, inflation index bonds. And that's a theoretical possibility, which actually got raised as the TIPS yields went up to 3%, and people were wondering, my God, can the government really pay these things off or not? But I think the question was, let's say, is all this debt going to lead to inflation? And I think, especially all this liquidity, as Professor Herring, showed, the balance sheet has doubled and even more than doubled. I think it's absolutely essential. I think that's a good thing. There's a liquidity crisis. Everyone wants liquid, safe assets. The central bank is there to provide them. But as soon as confidence returns, they have to withdraw this liquidity. There's absolutely no question. The good thing that happened yesterday is that the 90-day T-bill rate went above 1% for the first time since the Lehman bankruptcy, which means there isn't like a panic into bills, which is a good sign, actually, that there's an alleviation of some of that anxiety that we have in the system. But if they don't withdraw liquidity, then you're going to have a lot of liquidity laying around that will find its way into prices later on. But we have to trust that the Fed is going to do the right thing, which is withdraw that liquidity as trust is restored in the markets. Incidentally,
I wanted to offer my alternative interpretation of the TED spread, or the spread between the LIBOR and the Treasury bill rate. With all of the array of special facilities that nearly all the central banks have to take in almost any kind of collateral that is remotely good, it's quite possible that what you're seeing in the LIBOR market is only those banks that don't have good collateral to deal more cheaply at the Fed. And so it doesn't mean what it used to mean. It may simply be a reflection of unease about counterparty risk, which is well warranted in this world where we...
Well, the LIBOR is unsecured. That's true. It's uncollateralized. But it's the fear that these big banks could go on. I mean, if Morgan Stanley, WAMU, and all these others can suddenly go under, AIG, you begin to, is any bank completely safe? If there's only a 1%, 2%, 3% probability that they're going to go under, all of a sudden, and that gets added to the
but the good quality banks are not going there for liquidity.
But you can look at the Bankers Association and look at the rate quote from all the banks, and they were all about the same. The American banks, the three Americans, were a little lower because probably they did have Fed funds access, which some of these Europeans didn't have. But they were all high. There wasn't a big difference in the rates.
They were borrowing at it, though.
Well, I don't know, and that was how much. But that means it should be discarded. I mean, you should price off a Fed funds target.
Yeah, that I wouldn't disagree.
Yeah,
because it means something different than it used to.
Yeah, absolutely.
Okay, question over on this side.
Yeah, I was just wondering, I mean, how much of this, I mean, the crisis is an accounting fiction? I mean, if banks are able to migrate their asset-backed securities from trading books to, I guess, hold to value, how much of this would have been avoided and how much of this going forward would be mitigated?
In my opinion, none of it. I mean, mark-to-market is not the cause of this crisis. This crisis is because banks overloaded and leveraged, and insurance companies in the AIG, and insured risky mortgage and housing-related debt that they thought or hoped was not risky. And in the way you know it isn't mark-to-market accounting is because when the Fed shopped these firms around, no one wanted them. I mean, forget about what you can apply any accounting you wanted to. Here's the assets, here's liabilities. No one would take them. Doesn't, you know, use whatever accounting you think is right.
But it is true that nearly every CEO who's gone down with one of these firms has blamed two things: mark-to-market accounting
and short sellers. Yeah.
And I think you're quite right that neither one of them has had anything at all to do with the problem.
No.
Very good. Is there a question? Yes, down here.
First, I would like to thank the panel for the insights provided. My question is, are the steps being taken by the Fed and government in the last 6 weeks addressing the root cause of the problem, that is the lowering property prices? Unless somebody addresses the lowering property prices, the housing cycle, nothing would actually happen. Jeremy actually mentioned the same thing. We are actually facing a liquidity problem, but once liquidity is provided, the problem that comes into the scene is fear of solvency. Unless housing cycle is put on its pace, nothing would actually happen. That's my feeling.
The problem is there's a lot of fixes, of proposals out there. It's too slow right now. It cannot, they're so complex, they cannot be done with a stroke of a pen. We're all going to value these at 80 or 70, and the government will take the remainder or whatever. And to actually raise housing prices, I mean, God would need inflation and all sorts of subsidies to housing, and that's, I don't even know if you want that.
And remember that house prices are really, in some sense, an intergenerational transfer. There are lots of people who are now buying houses who could not previously afford them, or who were too prudent to overextend themselves to buy them.
Yes, my point on that is, can the government actually sell these foreclosed houses at maybe 50 cents a dollar to people? Meaning people, I mean here are people with good credit score, by giving some sort of confidence. This would actually liquidate the banks directly by the people's money, not by the government's money. And the government would actually be helping the people, not the big companies.
But that's what's happening in private negotiations between banks and the borrowers. There's tens of thousands of short sales going on right now, where someone underwater in their mortgage is getting permission from the bank to sell it underwater to a new borrower. That's already happening. Now, whether there should be some overall structure of the government to help people get a framework for it, because it's sort of an ad hoc basis right now, is probably a good question, but that's what's happening.
Taking that just a bit further, I think the way the government usually does this is part of the problem. They usually do it by encouraging people to over-leverage. So if you have an FHA mortgage, or if you have something for Fannie or Freddie, what they basically do is allow you to take a more leveraged loan than you actually should. If they really want to help people own homes and keep them, they really should be subsidizing their equity stake in the home. And so far, Congress hasn't wanted to face up to that, because that would mean allocating the funds and actually having to pay for it out of taxes. But if we really wanted to do it right, I think that's what we should do, and have a much more stable system.
I should point out that there's an additional problem that Jeremy and I have talked about directly, which is the mortgages which have been securitized, which is a large proportion of the mortgages. In that case, there's no one that you can negotiate with, because the mortgages are split up in so many tranches and they're owned by so many different people. Technically, it's a very difficult thing even if we had a government program that said, let's go in and buy these mortgages. What exactly, how do we actually do that? If we have one bank, we can go to the bank and say, let's make a deal. Let's make a deal. We're going to have the owner pay something for the house, and you won't have an abandoned house. That's something that's feasible. But when they're securitized, you have to realize how much securitization has changed even this simple problem of subsidizing mortgages.
There was a serious attempt in Congress to broaden the scope for the agents that were servicing these mortgages to renegotiate them. And it was pretty much stopped dead in its tracks by a number of investors who said, look, if you tamper with this again, we're never again investing in securitized mortgages, that you'll change the payment priorities that we were counting on, you're expropriating what were our property rights, and so it didn't really get very far.
We have time for one or two more questions if they're quick questions and responses. Has a microphone been given to anybody in the middle? Okay.
Hi, thanks for your thoughts. Given sort of the real erosion in wealth, particularly in the part of the American consumer, and starting to think about the next steps of this thing, which is sort of a consumer-led recession globally, what steps from a prescriptive or restorative standpoint can the government take to step in, I guess, and act as that sort of, I guess, buyer of last resort, for lack of a better term?
And this is a really difficult question. I mean, a big question people are asking, is a savings rate going to suddenly rise now? Because with the days of easy borrowing and lending are over, the consequences of over leverage are now very apparent. What happens if the household in the U.S. suddenly goes to a 2, 4, 6% savings rate like we had in the 90s, or even higher as we had even before? That's a big downward shock to aggregate demand, the only thing that I can see, and not that I like it, but you're going to have to use tax policy or fiscal policy of some sort to try to offset some of that shock. I mean, it's interesting to look at what happened in Japan, and because they tried to do that with, some success, but we would end up with even a bigger debt at the end, but maybe we'd keep the economy moving a little bit further. I would like to know what other panelists think about that, or if they've thought about that issue.
Well, in fact, we have a huge amount of empirical evidence. This is not a unique problem. We've had housing-created financial disasters in at least 100 countries around the world. And the World Bank has actually done a lot of pretty serious research on what works and what doesn't. And what seems to work best is to take your write-downs early on, to try to separate the good assets from the bad assets, to sell off the bad assets even if they're at very low prices and get them back into the economy. And you have sort of, it's in a sense a sort of shock treatment, but it seems to lead to greater speed in recovery and less of a fall in per capita income over time.
Is there one more question? Is the microphone over here? Yes.
Hi. We have a very large fiscal deficit right now, and I was wondering what role, like we're borrowing so much from China, what role does that play, if any, in the, or what role will it play in the current economic crisis?
Well, I think it's just natural in a recession that the fiscal deficit deteriorates quite markedly. Last year's fiscal deficit, strangely enough, was not very large. It had been coming down during most of the years of the Bush administration, after initially rising sharply with the tax cuts. Last year, the fiscal deficit, federal fiscal deficit as a percentage of GDP was only 1.2%. This year, it's going to balloon like crazy. It's going to be even worse next year. And that's a cyclical movement. That always happens during a recession. And what happens after the recession is revenues, tax revenues start to rise, government expenditures involved with the recession start to decline, and the fiscal situation improves. There's a longer run deficit problem, which is the only one I worry about. I don't worry about the cyclical deficit. What's the big deal? We have a very substantial borrowing capacity in the federal government. What I worry about is the longer term, and that's due to the entitlements and the aging population. And we all know that that's a very serious problem. If I were advising the new president, what I would say is focus on that. Ignore the short-term fiscal problems, but try to do something with entitlement reform. The last few presidents have ignored it, and our future fiscal situation is going to be very serious. Sometime later in the next decade, Social Security revenues fall short of Social Security expenditures, and the medical situation in this country is horrendous. The government expenditures on medical care, they're going to grow. As my generation retires, it's going to get more and more serious. We have the baby boom population getting close to retirement. It's going to get worse and worse and worse. This is worse in other industrial countries, but, you know, only by comparison. That's the fiscal deficit problem we have. It's not the current cyclical deficit problem. That'll go away with the recovery.
What about the current deficit, current account deficit?
Current account deficit is an absolutely different question, and I refrain from answering the question about savings because I'm actually in favor of a substantially higher savings rate in this country. That's the one thing that could have a substantial impact on the current account deficit, and I don't know whether I'll believe it'll come, but at some point the American consumer is going to have to save more, and that's really going to turn around the current account deficit.
Nothing like a credit crunch to do that.
That's right. Hopefully it will do it. We'll see.
I mean, I certainly hear, you know, a lot of rhetoric during the last few years about the Chinese buying our debt. I mean, keep in mind that's a good thing. I mean, a couple of years ago, when everybody was worried about the fixed exchange rate, when I was in China talking to their equivalent of Treasury Secretary, I personally thanked them for buying our debt at inflated prices. It was a nice little transfer to the U.S. Treasury. I mean, what would you rather have? Not high demand for our debt? I mean, that would mean higher interest rates that we'd have to pay. So this is a good thing. In terms of the entitlement problem, I think we're all in agreement. That's the big train wreck. I mean, and that's something that we have to deal with. The one thing I guess I would, in terms of the previous question that dealt with that really needed, I think, still answered is what could potentially happen. I think it's quite possible we could have very high inflation rates. We could have a default in real terms through inflation, monetization of our debt. I think it's inevitable that Congress typically will wait till the crisis is imminent. In this case, however, that will be simply way too late. Every year, I mean, if we talk about accounting and accounting standards, the U.S. federal accounting budget is a completely fraudulent accounting system. I mean, it basically makes Enron accounting look pristine. I remember I mentioned that in congressional testimony, both Republicans and Democrats. No one followed up because, you know, Democrats want to spend more money, Republicans want to do tax cuts. Everybody is in agreement with a fraudulent accounting scheme in Washington. I mean, if you measured the deficit correctly, it wouldn't be $400 billion or $500 billion. It would be about $2.5 trillion if you did it right. And the fact of the matter is, this is the serious problem. And the $1 or $2 trillion that we spend on this subprime mess, it's in the tracking error of any estimates associated with the entitlement shortfalls.
I sometimes point out the only time anyone is going to worry about the deficit is if interest rates start rising. As long as there's an appetite for the debt, you'll never get any action, ever.
Okay, well,
final word.
Yeah, final word. You got it. Well, one of the true benefits of being at the University of Pennsylvania's Wharton School is that we have faculty like the four here, the representative of the kinds of colleagues I interact with and you take courses from. It's a real privilege to have you share your wisdom and knowledge and expertise on economic and financial matters that are the most critical of our time. So thank you very much for your time and generosity of your wisdom.
For more information, please visit knowledge.wharton.upenn.edu.